Hi, hello, good evening, friends, fellow traders and investors. Warm welcome, one and all, to Option Omega 2.0, India's largest retail option traders online conference. Friends, this is Ashok Devanampriya. I'm the founder of Traders Gurukul and also the host for today's session. It's a great pleasure to see people coming in large numbers. We have successfully completed more than 6,000 enrollments into our program. The program partner for Option Omega is Money Control Pro, the largest financial portal in India with close to 20 million visitors every month. Thanks to Money Control team and their leadership for joining us on board to extend our knowledge mission to a wider group of stock traders in India. We would also like to thank our broker sponsor, Upstocks, one of the leading and successful discount brokers in this country. Today is the fourth session of the conference, friends. And the speaker for today is Mr. Abhijit Phatak. We call him AP sir from Pune. He's a SEBI certified research analyst. He has been studying and trading charts ever since 2003. He had developed a unique method of identifying what the market basically on the basis of option charts and also straddles OI of options, put call ratio and various strike prices. So he plays a lot with options. Definitely today's session is going to be a very interesting session for all of us. Well, AP sir, on behalf of the Traders Gurukul family, Money Control Pro family, the Upstocks family, and all the 6,000 participants who are joining us today from across the world, I extend my warm welcome into the program.
Thank you.
So the stage is yours, sir. Go ahead, take our audience into your world of simplified options.
Okay, thank you, Ashok, and welcome. Yeah.
Hi, hello, good evening, fellow traders and investors. Warm welcome, one and all, to Option Omega 2.0, India's largest retail option traders online conference. Friends, this is Ashok Devanampriya, the founder of Traders Gurukul and also the host for today's program. It is great pleasure to see people participating in great numbers. We have close to 6,000 registrations so far. The program partner is Money Control Pro, the largest financial portal in India with close to 20 million visitors every month. Thanks to Money Control team and their leadership for joining us on board to extend our knowledge mission to a wider group of traders and investors. We would also like to thank our broker sponsor Upstocks, one of the leading and successful discount brokers in the country. The speaker for today is Mr. Abhijit Phatak from Pune. We call him AP sir, a certified SEBI research analyst who has been studying markets on the basis of charts since 2003. He has his own unique method of playing with markets on the basis of option charts particularly, and also inclusive of straddle OI of options, put call ratio and various other means. So AP sir, on behalf of Traders Gurukul family, the Money Control Pro family and also the Upstocks family, and additionally on behalf of all the participants joining us today from all across the world, we extend our warm welcome to you into the program. And I think it's great pleasure to welcome you 2 times. I never did so far. Thank you very much, sir. The stage is yours. Go ahead. Please take the audience into your world of options.
Thank you, Ashok, and welcome everyone. We'll have to, like you said, we have to redo it again because it was not getting recorded. So I'll repeat some part of what I said earlier. I'm sure most of whoever follows me on Twitter have been seeing whatever charts I tweet are mostly about options charts. And this is something which I've been following for more than 12 years now, almost from 2008, 2009. And in those days, of course, hardly anyone was doing it. So I'm not sure who else was doing it, but I'm definitely one of the first ones to do it. And of course, that time also, and even now, people who read textbooks on options, because that is mostly about Greeks, they I mean, argue with me and discuss that this cannot be done. It is not done. I mean, what cannot be done? There is no rule, there is no law that it cannot be done. So I just started plotting charts of options in those days, more than 12 years back. And I realized even, I mean, the way charts of stocks tell a story, even charts of options tell a story. And of course, after that, I took it further, developed it further into charts of straddles, triangles, and all that. So, of course, today I'll be speaking only about charts of, I mean, stock options, because I have already spoken on index options and straddles and triangles in earlier sessions. So without any delay, let's get into the subject straight away. So I'll be talking about identifying low risk, long setups in stock options. So I think he has already given the introduction, so I don't have to repeat it. So what are the important points to keep an eye on? So these are some key things which I always look for when I'm looking for any long options trade in any stock. One is try to understand the trend of the underlying, whether it is sideways or whether it is in a trend, because historically everyone knows, it is well documented that most of the trending phase happens in hardly 30 to 40% of the time, and balance 60 to 70% of the time the stock, or in fact even index, is sideways. So as long as you are good enough to understand that it is trending, that phase starts there, of course options charts help. That is what I'm going to talk about. But that is the key thing, because if it is going to be sideways, I mean, of course today I'm going to show an example of ITC as well. So the most hated stock by people who are long-term investors in it, and the most loved stock for people who do strangles or straddles in it. So that will also show how a trend can be identified. So it is not only about good trades which have happened. I am also going to show a couple of bad trades which have happened, even if you had taken them. For that, what I require, what I always see is chart of the at the money call and put of that underlying. So let's say if Maruti is 7,000 today, I look at the chart of 7,000 call and 7,000 put. The biggest mistake which people make is they go for the OTM call, or if they are bullish on Maruti, they go for the OTM out of the money, maybe 7,200, 7,400 call, even if Maruti is 7,000. So that is a big mistake, because that is, I mean, everyone knows what is the option price comprising of. There are two components. One is the intrinsic value, and one is the time value, which is also called the extrinsic value. So if Maruti is at 7,000 and you're talking about a 7,400 call, there is no intrinsic value in it. So you are basically trading the time value only. And for the biggest villain in long options is the time value, theta. So what is required to negate that is momentum. So unless you have momentum in the stock, that is not, the OTM call is not going to rise. The argument given is the 7,000 call is too expensive. It is 300 rupees, whereas the 7,400 call is only 50 rupees. So I'm taking a chance, and 50 rupees is just 5,000 rupees, because Maruti lot size is 100. So I'm just taking a chance. But then the sentence which says I'm taking a chance is gambling. Let me put it bluntly. So if you want to gamble, then go ahead, buy our OTM options. But if you are interested in making this a serious trading strategy, then you have to look at the money call and put. That is what I have seen over the years, because there the intrinsic value is the maximum. Of course, in the money it is more, definitely, but ATM is good enough. Another thing which I also follow is importance of open interest in those options, because everyone knows in fact over the last 3-4 years, the concept of open interest has spread quite a lot. Earlier people, in fact, like I said, people ask me for book references of whatever I'm going to talk, or whatever I keep talking. So whatever I talk is not, at least I have not seen it in any book so far. All these things which I talk about are developed by me myself, and there is no reference book. So I have not read anything. But open interest is something which has been well documented, and most of the theories which are of open interest also can be applied here. So once you understand the trend, and once you understand how to track the open interest, that is good enough. Another thing which I also place an attention and place an importance is the volumes of the options. Many times I see a big spike and there is no volume. I mean, that volume might not be immediate, but at least over the next few maybe couple of hours, the volume has to, I mean, it might need not be a big volume bar, but I'll show you the charts when we go forward, what I mean by volumes. Another thing which is also not so popular even now is put call ratio at individual strike price. Now, this is a very interesting subject which I have seen over the years. In fact, again, here, a lot of people talk about overall put call ratio. I mean, even in Nifty, people talk about overall put call ratio, which takes into account the open interest of puts and calls across all strike prices. So even if Nifty is at 16,400, there is open interest at 17,000, there is open interest at 15,000 everywhere. And that is the total put call ratio, which is a bit misleading, and it is not a tradable indicator. So what I started looking at is the put call ratio at individual strike price. Now this is one thing which has helped quite a lot, because I have seen a lot of times people start talking about some sudden change in open interest at, let's say, 16,500 call or 16,000 put. In fact, last month, someone sent me a message about some 15,500 put, huge change in open interest. But I don't look at that, because as long as the at the money put call ratio is something, okay, at the money and one higher and one lower, that is enough for me to identify, because that gives you the trading uh, trigger. What is happening at 15,500 is none of my business. Who does that? I don't. The one thing which I have realized over the years is what not to do, and one of the things is never ask questions. What is happening there? Why it is happening there? Because whatever is going to happen has to. Let's say if Maruti is at 7,000, it will happen on the 7,000 call and put. What happens at 6,000 put or 8,000 call is none of my business. A lot of people take it as a target that Maruti is going to, but then let the at the money call give the signal first. So over the years, what I've seen is, if you look at the at the money put call ratio. Now, what is a put call ratio? It is again on open interest, not on volume, because some people follow the open interest on put call ratio on volume, which I don't follow. I follow the put call ratio on open interest. So P upon C in OI. That is what I follow. So if put call ratio is going higher, let's say it is 1, it becomes 1.2, it becomes 1.3, it becomes 1.4. What does that mean? When the P upon C equal to OI is going higher, that means there are two things which are likely to happen. One is the OI of the puts is rising. Second thing is OI of the calls is going down. So the numerator increasing and the denominator reducing. Even if one of them happens, OI will still rise. But when both of them happen, the OI, the PCR rises with big momentum, and that is the time when the underlying is also rising. Because what people don't understand is, that is something which I always follow. When put writing starts, the call covering will not start immediately. Put writing is basically a base being built by the people who are bullish on the stock. So if I am seeing 16,300 put open interest being built up, that does not necessarily mean that it is bullish. That for me, that only means that it is not bearish. This is something which is extremely important. Below 16,300 is going to be unlikely, because 16,300 put OI is rising. So what happens first is the base is created. If anyone is from the civil industry, they'll understand what is a foundation. So that foundation is created, and then once the underlying starts rising, and only then the open interest of the call starts falling in the getting covered, and then the denominator starts falling. So first the numerator increases, then the denominator decreases. Effectively, the PCR goes up. So this is something which I follow regularly. Of course, I am not covering that today much, but still I'll be showing some charts of open interest also. So let's get to spotting a potential trade. What all do you require? What happens when underlying is trending or likely to trend? Let's say there is an underlying. Let's take an example of Maruti again. So if Maruti is, there is a possibility that it is trending. What are the things which can happen? Most of the times, for me, I have developed an eye, and of course, there is no reason why anyone else cannot do it. I'm an ordinary human being like anyone else. So as long as you have the aptitude to look at a chart and understand what is a trend, which anyone in the market is expected to have. So most of the time, the call or the put chart, sometimes both, tells the story. So if the underlying is rising, first thing which has to happen is the open interest of the put has to start rising, like I said in the PCR. And when the open interest of the put starts rising, the premium of the put has to go down. What happens on the actual terminal is puts are getting sold. So basically, whoever is bullish on whichever option writers are bullish on the stock starts selling those puts. So they will show a downward momentum. So when a trend is about to start, first activity which I always observe is whether the put at the money put has started going down on the chart itself, on the chart of the put. If that has started going down, the chart itself tell me whether it is going down, drifting down, or it is sideways, or it has a good momentum. At the same time, the OI